Welcome traders. We have a fantastic session here. Now at Master Trader, we are technical traders where everything starts with a compelling pattern, and then that dictates whether it's a stock or option, and a directional or what I call an income trade, which is just selling credit spreads. I know there's a lot of option traders, other speakers and traders out here. I love options. The majority of my trades are involving options, and again, that's directional and income. But what we're going to talk about today is what happens when these patterns fail. Technical patterns suggest behavior. They're showing the collective sum total of the supply and demand of whatever you are looking at. Stocks, ETF, currencies, anything that moves is the collective market participants' beliefs about what the value is on that, and we make interpretations of future actions based on that. So setups can and they will fail. That's a fact of life. And the interesting part about that is it sets up the unexpected. So we're going to talk about what I'm calling these shock patterns. Not only if you're in the trade, because that will happen, I guarantee you. And our success rate of trading stocks and options with technical analysis is over 85%. So it kind of just blows my mind that there's some traders out there, particularly these mechanical option traders who don't believe in charts and they just trade by the numbers. But with 85% accuracy, why on earth would you not want to stack the odds in your favor of having a bias before you put on the proper stock or option trade? So I'm going to show you these. So not only if you're in the trade, but more importantly is to recognize when the pattern has failed to create new opportunity for us. So I've been at this over 20 years, and we've technical analysis. I've worked for a prop trading firm. We consult for hedge funds, high net worth individuals. And the only reason I'm showing you these two pictures of what I love to do, I fly, I love yachting, is not to brag about anything, but it's to say that this business that we're in of trading is, in my opinion, the most phenomenal opportunity of a business in the world. We can take our laptop, go anywhere in the world, and we can find and create opportunity with our laptop with a proper objective approach. So you don't need any schooling, in my opinion, whatsoever. You just need an objective approach, and me being a pilot and a master captain and even an expert pinball player when I was a kid. Those skills, in my opinion, are more important than getting a graduate degree in accounting or finance or any of that nonsense, because that does not help you understand what really makes the markets move and how to successfully trade stocks and options using technical analysis. These are some of our top patterns. I'm not going to review them in detail, but we're going to see them in many examples here. Buy and sell setups, breakouts, continuations, igniting gaps. I am going to spend a little time on these igniting gaps and these M&W reversals as it relates to the shock pattern. So what is a shock pattern now? Well, very simply, it's when an incredibly high probability pattern where you're like, this is a no-brainer, it fails. Well, the failures can occur in many different flavors. I'm going to show you how they can occur with these gaps, failed breakouts and breakdowns, shakeouts, these M&W reversals after they trigger a new high or low. I'm going to show you what we call these RBIs and GBIs. They're big red or green bars that are ignored. Now, just because a red or green bar is ignored, that's not a pattern. And none of these are just patterns in and of themselves. We have to go through the rest of our checklist to make sure multiple time frames, make sure it has what we call a price void, which I'm going to show you many examples of, and relative strength or weakness. And we have our checklist before we enter a trade. Now, every one of these are different levels of shocks, but I want to show you two things on this page. One is, let's first talk about the red bars, and then I'm going to show you how we love selling credit spreads on these reversal patterns. So whenever you see a red bar on whatever time frame you're trading, that means that the bears are in control of that bar because it opened at one price and closed below the opening price. But it's the overall pattern and arrangement of the candlesticks on multiple time frames that puts the important messages together to tell us what the tradable opportunity and the amount of the shock is. On the next page, I'm going to show you the gaps as a shock, but many times these are expected. Like this upper left is what we call our master trader buy setup. So the retracement in an uptrend on support with a reversal combination of bars is expected. This is a consolidation. I don't know what the bigger time frames mean. I don't know if this is a consolidation to go down or up, but these red, green, now this wide range bar, it's decisive on the upside. We're going to talk about these W bottoms more in a few moments, but this is what we call a downside shakeout or a breakdown failure. And it's also what we call a 180 reversal. What that means is you have an ugly wide range breakdown bar. Now folks, we're all traders here. Pretend that you were short in that bar. Assume it's in a downtrend, assume everything's wonderful. You are very happy. You're like, I nailed this, I shorted this, my unrealized profit is big. And then the very next bar, it reversed. And if we have this price void above, which I'm going to show you, then this is a very potent reversal. And then this one also was a flavor of a downside shakeout. It was a beautiful breakdown, but before the bar closed, wait a minute, I now have a bottoming tail and it closed back into the consolidation. That's a very valuable message right there of a breakdown failure. So these lines I'm showing you is how we love to sell bull put credit spreads. We find bullish patterns where we say, hey, that support looks like that's going to hold wonderfully. So we sell a put option under support. Then we buy a further out of the money put option just to limit our risk and the capital required at the brokerage firm. And then the difference of those two amounts is what's called the net credit. And then that is our potential maximum profit as long as the stock expires above this green line, the strike price. And again, we do the directional trades and we do these income trades. I'm going to show you a lot of very compelling patterns here that are directional trades because they have the beautiful shakeout with the price void. But any pattern where we're just calling a short-term top or bottom, we love selling these credit spreads. And in fact, at Master Trader, we have a whole separate advisory letter dedicated to that called the Weekly Options Trader. All it does is sell options, mostly spreads, but sometimes naked, around these compelling patterns where the option expires in 10 days or less. So we're taking advantage of, well, the three components of option pricing that we would make money on is number one, the directional. So with those reversal patterns, if the stock's moving in our intended direction, we're making money since the option we sold is decreasing in value. Number two, any kind of volatility contraction. And number three, time decay. So if we sell a 5-day put spread on a bottoming pattern, day by day, even if the stock goes nowhere and just chops around and does nothing, we still are making money in our account because we can buy that option back to close it at a cheaper price. All right, let's continue. This is a shock pattern, what we call a pro gap professional gap. And it's some type of it could be a consolidation. It can even be a downtrend, believe it or not. But it's a gap that shocks all of the bears in this sideways or downtrend and consolidation. And then we make sure that the gap's going to hold on our intraday time frames. And provided there's a price void, then we do our directional stock and option trades. This stock was in a multi-month trading range, just shorting the highs, shorting the lows. So whether you're a bull or bear in here, but these three red bars are the bears. Now, what happened on this particular day is look at the gap. And we don't care the reason of the gap. It could be earnings, it could be good news, it could be bad news. In fact, I prefer it to be on bad news because that's a bigger shock. Very little tail, which means on the gap up, buyers were stepping up. I'm showing you the weekly chart here also. This was a breakout on the weekly chart. And that is a beautiful pattern for a bullish stock and option directional trade. Another example here, just a couple days ago, we did for our subscribers, another trading range here, but this is the shock part. All the folks in this red bar, that's a bearish engulfing bar in a trading range at resistance. So the bears should have gone home happy. Very next day, gap breakout, no resistance to the left. That's what we call a price void. A price void, if you're long, means insignificant resistance to the left. Again, very little tail. So over a 5 or 10 minute high, we were recommending bullish stock and option trades. JD, another one here. This one actually was yesterday. We gave this to our subscribers. Same concept as the other one. Two red bars here at resistance. It gaps up, no tail, and we buy, I think it was a 15-minute high yesterday. So yeah, you're going to get the flavor of these. So I have a lot of slides on purpose just because the messages are going to jump out so easy of these shock patterns. This was some movie company, I remember, HMNY. Now there was some bullish activity here. So all the bulls in this bar and then even the next bar were happy. They were very happy, thinking they nailed the low of this thing. What happened here? That's a bearish pro gap. Everybody who bought in these bars are holding losing positions. We teach all the aspects in our Master Trader Strategies course, how this is just a bearish institutional selling chart here. This was another beautiful breakdown, and you can tell by the stock being at $1,100, they had a number of reverse splits. And look at this, we were shorting this so many times, and this was at 21 bucks. Look over here on the left, folks. This is 1 penny. The company went bankrupt. It's trading for under a penny, and it was $1,100 at one time. Most of us should be familiar with old Roku, recent IPO. It's very volatile stock. It's been good to the bulls and the bears, but let's talk about the shocks today. Now, this is a big bullish gap there. So all the bears here were shocked. Nice uptrend, nice pullback. Look at this run. Not one single red bar until here. Closed at the high, gapped up. The bulls were happy as can be. And then what happened at the end of the day? Big bearish engulfing bar, a gap down, another red bar, bearish consolidation in the bottom half. What then happens? Another gap down. This is where on this bar, so see my little note here, at every star, we were selling these first 2 stars, we were selling out of the money call spreads. And on these other 2 stars, we were selling out of the money put spreads. But on this bearish gap down from this overall pattern, we were shorting the stock this day. Then this is what we call a master trader bear 1, 2, 3 pattern, which triggered with the gap under the green body opening price. 5-minute low, we shorted it again. It's starting to get its sea legs back here on this prior support, and then we turned our bias to the long side. This is a very interesting gap that I've labeled it a special name, and it's called the bearish gap that bullies. What the heck does that mean? Well, that's a bearish gap. The stock closed here and it gapped down, over $2. And what happened? On the right is my 15-minute intraday time frame. Bearish gaps that fill the gap in the first 30 minutes with a price void. Again, remember, price void means it had a big move down and there's insignificant resistance to the left, which means it has room to advance towards the prior resistance areas. That's on my watch list to get on board long. And so it moved up, consolidated in the upper third of this bar, which is very bullish. The next day, we bought the breakout. Bearish gap that bullies, and it obviously works in reverse. Look at this shock pattern. One of these, remember marijuana was the Bitcoin stocks when they had their frenzy. So look, this was a dollar stock, went up to 14 and change, and then this is what we call a climactic buy setup. So this is on our watch list to short. It's just a matter of when I'm going to short it. Well, the next day it had a bearish gap, and so we were looking to short it on a bounce. This is a shock that I'm calling a downside shakeout. This had a big move down, bearish. This is in a downtrend, folks, right? Lower lows, lower highs, beautiful breakdown. Didn't go very far. Went sideways, went back up deep into resistance. Now we are monitoring this in the afternoon to go long because of this big price void. And it's also, for you classical technicians, it looks like a reverse head and shoulders. So we bought this breakout here, stop under these tails, and manage in between. This is a shock pattern that I've also given a special name to, called the bear and bull sandwich, but I'm only going to show you the bear one. When you have, and here's the setup right here, it's very simple. I have two wide range bars, bullish ones. So I got a big green bar, and the middle bar is a big red bar. So just like when you go to the New York deli and you say, hey, I want a chicken sandwich, the chicken is in the middle of the bread. That's why I call this a bear sandwich, because these are the bears. Any red bar is a bear. Like I said in the beginning comments, that doesn't mean that these are tradable in and of themselves. You still have to overlay the other master trader components to see if it's a high probability setup. And this one was. Because of the retracement back to resistance, I have rising 20 and 50 and 200 period moving averages, and the bear sandwich was a shock which made this breakout more powerful. This is a shock pattern that we call a breakout failure. It's been in a strong trend, uptrend. You have a couple of sideways consolidations, bullish breakout. The next bar should not be a bearish inside bar. That put us on alert. Danger, danger, possible breakout failure. The next day it gapped down, which made our entry a little tougher because your stop has to be the prior bar's high. But then we got the luxury of 2 more sideways bars and it gapped down again. That was our short entry with a stop over these topping tail bars. Breakout, that was a breakout failure. Now here's a different flavor of breakout failure. Nice uptrend. Here's a nice red bar ignored right there because that suggested lower prices and it immediately returned. So a concept that we say no follow through to red bars is a bullish event. So this bar right here closed to new highs. So that was a beautiful, beautiful bullish close and a breakout. You could buy over the high of that. Stop under, either this bottoming tail or give it a little further over here. The next day it gapped down a little bit, but then continued to rally. So keep in mind when you're looking at these candlesticks, this is the close of the candlestick. At the high of the candlestick was a big green bar. So the bulls were very happy that they bought a breakout and it closed, that it was at one time in the day, it looked beautiful. And now at the end of the day, it closed with a topping tail under the prior bar's low. That should not have happened. So that is your shock pattern of a breakout failure. The next day, it closed green with a little bottoming tail, so it's neutral. But then the next day where it closed under this green bar and I have a price void because of this big move here, that was our short entry. We love trading these M tops and bottoms, and I'm just giving you 3 different flavors of them. This is what let's just focus on the bullish ones here. So the stock came down. Now, bear in mind, this is still in a downtrend, right? So it's down, it bounced a little bit, and it made a new low, which the bears thought it should do. But then it closed with what we call a potent reversal bar. Potent meaning it stands out, it's big and fat, and it engulfed this thing. With this price void to the left, that's a very powerful reversal signal. This is just a different flavor. We say deep move into resistance and then a retest of the prior low. Third flavor, this is my potent reversal on the first one, and then it comes down and retests it again. Those are all different flavors, but I kind of like the new low the best because it sucks in new bears on the breakdown, and then they're shocked and have to scurry to cover their losing position. This was Facebook. Volatility rises on these sell-offs and when they're in the middle of the news. So this was a couple months ago. The FTC was probing Facebook over their use of data. The stock dropped 12, almost 13% in 3 days. And so when I see opportunity like that, folks, I tell the people in our green trading room, we will be trading you on the long side. It is just a matter of when and what the picture looks like. Well, this picture turned out to be a beautiful W bottom. And we were day trading it, but because of the high volatility was off the charts. These are one of our favorite types of selling bull put credit spreads. And we sold the $155 way out of the money puts. We bought the 147s, took in 56 cents a share. So if you did a 10 lot, that's $560 goes into your account. Folks, as long as it closes in 3 days above 155, you make 560 bucks. But we still stop out. We don't go into hope mode and just roll in perpetuity like some people do. If the pattern which substantiated the trade fails, we get out. And then we hit the sidelines and wait for a new setup. So over the high of this bar, we sold that put spread, stop under the lows, or maybe I said $1 under these lows just to give it a little bit of wiggle power. And this was 7.5% return on capital. And the stock could still go 6% against us. These are some other flavors of reversals. You know, pulled down the support and this gap fill. It's chopping around here and then gapped up. That's our go ahead to buy the stock for a swing trade and also to sell these out of the money put spreads. Another one came down hard, held this major. Now see, this is a price void. When a stock goes straight up like this and doesn't pivot, it doesn't have significant support on the way back down. So this was our major pivot support right there. It held, it bounced up, held it again, red bar ignored. That's what we call a no-brainer setup. And that also would have been perfect for any bullish stock or option trade. HFC, this is actually a trade of ours that we're still in. Now this was a breakdown. You can see it was in a downtrend, lower lows, lower highs. I've declining 20, 50, and 200 period moving averages. This is what we call a bearish 1, 2, 3 breakdown. So folks, let's just pretend that I took that trade. That is a quality short setup. You have a wide range bar, you have an inside bar in the lower 1/3. It gapped up and traded under these lows. That's a valid short setup. The next day, it closed green above the open. So we would have said, okay, you know, no harm. But the very next day, it retraced that. Red bar, inside bar, gap down, trades over the high. We would have been out of that trade. We would say this is telling us that this stock is not going down anymore in the near future. You see the explosive move that it did? Here, it broke down again. It traded under this major pivot support, a bullish 180 reversal. It had a bullish close, a red bar. Remember I mentioned that term, a bear sandwich? This is close to being a bear sandwich. We gave this to our subscribers over the high of this green bar, and it had a beautiful move up. This is the perfect examples. Intel here, there's two beautiful shocks, two. This came in, nasty downtrend, tried to bounce. This bar, just ask yourself, folks, if you were a bear in this bar, you would be at the local happy hour saying, yep, I'm short Intel, it's a dog, it's lagging the SMH sector, closed at the darn low. The next day I'll be buying drinks, and then it gaps up. 3 inside bars. 3 inside bars and then a gap up, and it's not taking out the low. The message of this bar, this gap up now has negated the meaning of this bar. Now it's on my radar screen to go long. Does that mean I buy it on this bar? No, because if you go through the rest of the master trader checklist, there's no price void, there's no pattern, but it's a definite watch. It moved up through resistance, has one bar here with a bottoming tail. Now I got you. I'm buying over the high of this red bar because I have a price void. It gapped up, and so we bought a 5-minute high. Here, pull back, gap fill, converging moving averages, ugly red bar suggested lower prices. 180 reversal again. Here's my bullish 1, 2, 3 continuation I mentioned. Inside bars in the upper third of this. Price void. This is what we call a no-brainer bullish setup. And that is what trading is all about. I'm talking about shock patterns. Even though I'm entering these no-brainer patterns, does that mean that Intel cannot open up at $49 the next day? Absolutely not. Of course it could. But we are technicians. We're trading the high probability messages of these patterns. All right, so one more example here. This, again, was recent, the recent Fed meeting. 15-minute of the S&P 500 ETF, the spiders. Nasty downtrend, you know, interest rates, trade wars, impeachment, you know, pick whatever flavor you want. We really don't care. The markets are at all-time highs right now with all this worldly problems. That's what we call noise. We trade what's called reality, and price action and candlesticks and patterns and trends and pivots is reality. So nasty downtrend, wide range igniting down on some, I don't know, 10 a.m. number. Deep. This is a deep retracement into this. It's getting its sea legs back, negated the red bar. So that's my shock pattern of what it negated it. It just took a couple bars to negate it instead of one. Then I got my buy set up, and over this green bar engulfing, we gave that as a long to our subscribers. And as you know, the spiders are at what, like 306 right now? This was the dead low of the recent reversal from this pattern that I'm sharing with you today, folks. The shock pattern of breakdown failure, red bar ignored, price void. You got to put all these concepts together.